Kia ora koutou and welcome to Markets, Mystics and Mayhem, a weekly podcast with Kiwibank's economics team alongside the occasional special guest. We'll delve into the data, decipher policy decisions, monitor the markets and analyse the issues impacting the Kiwi economy. Let's get into it.
Okay, well, hi, welcome back to another episode. Today we're going to be doing a bit of a US special, which kind of sounds a bit funny because almost all the episodes we've done recently have at least some element of what's going on in the US. You can't avoid it. But today, more specifically, we're going to be looking at some of the more high-frequency data that's come out of the US over the past week. We've been really sitting and waiting and watching, or mainly waiting for data to actually, come through and show some of those tariff effects. It's been a bit early up until recently. To be honest, it's probably still a bit early, but I think we are starting to get to that point where we are seeing some of the effects flow through onto the data. But we've also had quite a bit of front-loading pre-tariffs, which have kind of clouded the sort of general trend going on. We are starting to see that unwind a little bit. And if you turn to sentiment, that's continuing to deteriorate. So a lot to get into, but I think where we should start, we should say that actually as of today, which is June 9th when we're recording, there's actually only 1 month left of this 90-day tariff pause. So Jarrod, we've had one deal. What are your thoughts? Let it all out.
Let it all out. Well, unfortunately, it's still early days, isn't it? We've still got a month to go. I think we're going to get deals coming through towards the end. But with all this uncertainty, we really need to look, I think, into the surveys and some of the hard data that's coming through out of the US. So, yeah, there has been quite a shock to sentiment in the US. I mean, what are we seeing in the surveys? Because, that's where we kind of get that feel quite quickly as to how things are playing out.
Yeah, it's the best data there to get a most real-time gauge of the economy.
Yeah.
And manufacturing PMI, that's still in contraction, so below 50, reading below 50 is contraction. And then services PMI, that fell into contraction. And then the components within that, things like new orders or production or new export orders, those are also signaling contraction. So it's kind of all flashing red as a slowdown in economic activity. But then on the other side, you had things like prices paid rising, so showing that firms are facing a lift in import prices or input prices. So you kind of get a bit of inflationary pressure coming from there. And then also just on the front loading thing, what we're seeing from producers is they're maybe kind of hoarding inputs as well. So supplier deliveries, that was an expansionary as well. So they're kind of holding on to these inputs maybe ahead of any expected tariff escalation, holding on to that, but then input costs are rising. So you're seeing this kind of slowdown in output, lift in inflationary pressures, but also this kind of strategizing how to go ahead in terms of tariff escalating.
And it's quite hard to try and figure out how all that balances out, right? Are we pulling forward activity and then there's a cliff afterwards, which seems to be potentially the case? Or, are we doing stuff that we would have otherwise been doing and it's actually a stronger economy? And then you got that inflation bit, which we're all looking at as being a spike that comes back.
Yeah,
that's
why it's just, you can't make, I think, any firm decisions on, if you're the central bank, can't make any firm decisions on just one data print. You need to see a trend forming here because, as you say, it could be completely reversed the next month if this is more of a response to tariffs escalating potentially, So you can't really say what the trend is just yet.
So, I mean, that uncertainty being the theme, unfortunately, just continues. Right, we really just need time to see this through. The way I'm thinking about it is a bit like the GST implementation in New Zealand and Australia. There's this GST coming of 10% or 15%. You front load, you buy stuff that you're going to buy anyway, but you just pull it in to save yourself 10%, right? The spike hits the inflation report, and we're sort of gliding on as we were afterwards. So it'd be interesting if it's just that or something else. And I think our view is that from a global perspective, there's downside risks to growth because you're hurting consumers and firms with these tariffs.
Yeah. And the same with the inflation, actually. If it's, your textbooks say that when you have a tariff, it's a kind of one-time spike and it'll eventually fall out. But if we're going to go back to pretty strong, elevated tariffs, there's risk that it's more persistent because it starts to feed into expectations and, wage growth starts to become, hotter than expected. And that becomes this kind of vicious price wage spiral if it's at that level. But at a level of about 10%, it should just be, that tax kind of approach where it's just a one-time spike. That's another thing that the Fed will have to be grappling with is it temporary or persistent, which sounds like during COVID, the same kind of debate they were having.
But I guess going back to the front loading and maybe coming off that. So a good example of that is what we've seen actually on the US trade deficit side. So we saw that the trade deficit widened quite significantly. I think it was over March, maybe a little bit even in the lead up to that with people, thinking about tariffs coming through. They had quite a large surge in imports. And then most recently now we've seen trade data over April and we've actually seen the US trade deficit shrank by a record amount with imports also falling by a record amount. I think it was 16 point something %, right, MJ? Big chunky decline in imports. So that's, you've had your front load and now that's coming off.
Yeah. And we saw car sales go like that and back down again as well. So there's lots of examples in the data.
Yeah.
If you're a central banker, how are you reading that?
I think you still would say that this is still early days. I think it's not an encouraging, direction for it to go, especially because we're still in that sort of 90-day pause and we're not, we don't know fully what the tariffs will look like in the end. And if they are higher, that would just add a bit more inflationary pressure. But I still think it is early days. We'll get into the labor market, but for now it's showing pretty good resilience to the trade shock. So for now, so they kind of have the ability to kind of wait and see how the data develops, even though there's some, flashing red signs here.
So the payrolls numbers that we've seen, there's still a bit of momentum in there for me, but it's bending, not breaking. So we have seen a slowdown in hiring, which is to be expected. Wages are holding up quite nicely, actually, at 3.9% over the year. Underemployment rates haven't lifted. The unemployment rate's flat. You look at it and you go, oh, that's a good report. What did we get on the weekend? It was 139,000 for the month, which was, above the 120 consensus. So, tick for another month. But if you look at the ADP data that came out, there's quite a substantial slowdown in those numbers to just 39,000 on the month. So there is a correlation there. There needs to be an expectation that I think the labour market softens from here. I think there's no doubt the US economy is going to be hurt by this. It's just how much.
And it probably should be say that the labour market probably lags the longest out of all the indicators too. So
exactly,
you won't be seeing that change in activity showing up in the labour market just yet anyways.
Yeah. And I think it's maybe incorrect to just hang your hat on just the payrolls number being stronger than expected, because if you looked at the the household labor force survey, which is where the unemployment rate comes from, it looked very similar to actually what we've been seeing here, where participation had fallen. And so that's why the unemployment rate looked maybe better than it should have been. And it's because people are moving and leaving the workforce. And so and there's also been the shift as well towards part-time employment and less and fewer workers in full-time employment. So very similar trends as what we're seeing here, which is that slowdown in the labour market.
Yeah, that's not necessarily showing up in the unemployment rate because people just leave the labour force, go back to school or retire.
Yeah, and there are signs of the tariffs starting to have impact, at least on labour market, because a lot of the job growth in that payrolls came from services. So I think healthcare accounted for a majority of the 139,000. Leisure and hospitality, those are services, which is in line with the services PMI, which showed that employment was positive over the month. So, but in the manufacturing, I think they lost like 8,000 jobs in the month. So there is the headline looks better than expected, but the details underneath are a little bit sketchy, or a little bit,
starting to bend.
Yeah,
starting to
exactly.
bend. Yeah.
So what does it mean for the Fed? Let's bring it back to that.
Well, I think they're assessing, like you say, they sound like they just want to sit there and figure out exactly how these tariffs feed through into inflation and activity, and how do you get that balance right? Is it a demand shock? Is it a supply shock? Is it inflationary? Is it deflationary? I think you've just got to feel your way through it in the United States, because it's harder knowing that these tariffs represent a tax, right? So not only do prices go up, but that hurts your consumer. So how does that play out? Whereas I think it's cleaner here in New Zealand, looking at it, going, well, we get a 10% tariff on our exports. Really, that's not I don't think that's a big deal. It's not going to cause the Americans to stop buying our meat. Or if a bottle of wine goes from $20 to $22, I don't think they're going to stop buying our wine. So I think we'll be okay. We may be relatively okay too, compared to, say, France or somewhere else. So I think for us, it's more about the global slowdown. How bad is it, and what does that mean for Fonterra, for example? They're offering a $10 payout now, which is a record, and they're forecasting another $10 payout for the next season, which is amazing. Does it eventuate? Yeah.
Does it last? It is interesting watching how commodity prices, specifically dairy and meat prices, which is what we're most familiar with, have been quite strong. So you're saying the tariffs won't hurt New Zealand exports. That's kind of playing through. Dairy prices were up, 13% or something like that, and export prices were up 7%. So those are pretty strong numbers for us.
Yeah. You're saying based on that 10% tariff, right?
Yeah, it's not really having much of it.
Yeah, but if you get a global slowdown, then we know that the demand for commodities does go down, and that'll push prices. So if we get to that point.
Yeah, which will take time, right? It'll take time to we've got to figure out what the tariffs are globally, for starters. We've got to figure out what these deals are, how they come through in the next month, or whether it's extended again. We've got to see where it falls. We have only had one trade deal, and even that trade deal is not fully done. So
it's not a very good example.
It's not a good
necessarily
example
either, because of the fact that they don't run a trade deficit. Sorry, they run a trade deficit with the US. So, because we're talking about how dairy and our commodities have been doing pretty good, is there, and I know we've only got a 10% tariff, do you think there's potential that that's been front-loaded as well? Or not really, because they're perishable items, right?
Yeah, it's a good question. Probably not. Not on the meat side, I wouldn't imagine. Wine, maybe.
What about
to the extent
like milk powder, though?
Yeah, so milk powder, my understanding's got a shelf life of at least a year or something like that. But it's actually a bit shorter, because as more and more powder comes to market, why would you buy something which is 6, 7, 8 months old? You just want to buy the new stuff. So it does have a shelf life. So yeah, the extent to which you can pull forward that, I think, might be limited as well.
Yeah, which makes the lift in export prices a bit more, I guess, genuine, because we're saying how it's hard to say or to make any trend when things are being front loaded, but the lift in commodity prices have been kind of genuine growth in world prices.
You know what? This is Markets, Mystics and Mayhem, and we haven't talked about markets.
Exactly.
So,
there we go.
Jarrod, what's happening in markets right now as we sort of still wait for more tariff outcomes, and also off the back of the data that we did see last week? Because we had weaker data at the start of the week. The US payrolls was a bit more positive than expected. So how are markets actually taking this all in?
Markets are really struggling, right? I think rates markets are doing some interesting things. I think rates markets are reflecting or trying to reflect, greater risk of more US debt coming through. This kind of rebellion against US dollars is kind of there. Haven't really bought into it yet, but getting out of dollars and going into euros and elsewhere, you've seen a little bit of risk premium going into the US 10-year. Not a lot, not as much as what the bond market vigilantes would like to say. The 10 years at 440, it would need to be at 540 for me to be saying people are dumping treasuries in a meaningful way. But we are getting some interesting moves in rates markets. We are getting those steeper curves with longer end rates rising. Here in New Zealand, there's reduced thoughts of rate cuts as well. And, with all of that going on, equity markets are just climbing and climbing and kind of at the highs. So markets have kind of handled this, I think, quite well.
There's definitely that prolonged, correction for a while when the Liberation Day tariffs came out, and it was a very big shock. And maybe it is just a time of idle, just uncertainty right now, waiting for the next announcement. Because actually on the tariff front, it's been relatively quiet. As we say, it's been just one deal that doesn't really seem like a proper deal just yet. There was a 50% tariff announced on steel last week. But besides that, hasn't really been much in the way of headlines. I know Trump and President Xi had a phone call, and that did a bit of a risk on kind of sentiment. But outside of that, it's been pretty quiet. So markets, I think, are just trying to get back on their feet, just waiting for the next thing.
Treading water.
Yeah.
I think that's a good way of saying it. That markets are treading water at the moment. I think they're handling the flow of news that we're getting. Even we're getting ridiculous news stories around Trump and Musk and bursting into tears and throwing their dummies at each other.
Someone take their phones away from them, please.
It's like a reality TV show, but even more extreme. I feel like this doesn't
not make this up.
Yeah.
Okay, well, I think that's it for our US special. Some risks ahead for the US economy, which is going to be, something we have to really think about because they are the world's largest economy, and if there's a 30 to 40% risk that they fall into recession, that's going to spill over to us. So we'll be looking into how that all plays out, keeping an eye on those high-frequency data, showing kind of mixed signals right now, but it's something to really keep an eye on. But that's it for us. Make sure you follow, subscribe. We'll be back next week.
You've been tuned into This is Kiwi Economics, Markets, Mystics and Mayhem. We'll be back next week for more analysis and insights.
Any views or information shared in this podcast, while given in good faith, aren't necessarily the views of Kiwibank.